Good evening. It is Sunday, August 27th, 2023, almost 9 p.m. on the East Coast. This is Rob Sin at CEO Technician on Twitter, at Goldfinger on CEO.ca, and Goldfinger Capital on YouTube. So, weekend video. These are the talking points from last weekend. These are the talking points for this weekend. Starting with the Jackson Hole speech from Fed Chairman Powell. He said a lot. He left room to hike more. He left room to pause for an extended period of time. And he left room to do just about everything. The Fed is data dependent, and his tone and his key talking points have not changed in months. The Fed is not done yet. They've not achieved the 2% inflation goal. That goal could be achieved by simply holding monetary policy in restrictive territory where it is, or it could be achieved by tightening further. There is no easing on the cards anytime soon. And when I say anytime soon, I'm basically talking about a 6-month time frame. I think it's hard enough to look, 3 months ahead. 6 months ahead is very difficult. More than 6 months is impossible. And his concluding remarks, we are navigating by the stars under cloudy skies. I mean, that was a brilliant way to wrap it up because that's true. We are navigating by the stars under cloudy skies. The outlook is murky. There's a lot of things that are different about this economy compared to previous economies. Risk management considerations are critical. So there's a discussion about what's the risk of overdoing it, and then on the other side, what's the risk of not doing enough? Right. So that's the conversation here the Fed is having. If we tighten too much, how much damage could we inflict? If we don't tighten enough and inflation makes a U-turn and surges again, then what's the cost there, right? And I think at this point, the Fed is pretty balanced in terms of the risk, right? The risk of not doing enough is very similar to the risk of overdoing it at this point. And I have a feeling a couple months from now, the risk of overdoing it could be a lot more, right? But that remains to be seen. The market, so let's go to Friday. This is the E-mini S&P chart. So this was Friday morning. The market gyrated at first. It jumped. Then it sold off aggressively. And then it found its footing and rallied a bit into the close. So you can see this, this 2-hour bar here from 10 a.m. to noon. That was a crazy candlestick. The high of that was 44.2775. The low of that was 43.6525. So you're talking about 62 S&P point range for a 2-hour candlestick. That's about as volatile as this market has been in many months. But, so that's enough on the Powell speech. I think the market, it got what it expected to get from Powell. I think bulls may have been able to take from that there were some clues that we are really getting to the end. I mean, if there is another hike, there's just one more. It's not like there's multiple hikes left here. There might be one in November. That's where we're at, right? And really, if the Fed doesn't hike next month, then you have to think, well, so they get another 2.5 months of data, and that data is just very unlikely to be too strong. It's much more likely here that the Fed is just on hold for the rest of 2023, and then come 2024, we'll see. But it's really unlikely that if the Fed is pausing for 4 or 5 months, that they're going to then start hiking again. It's just unlikely, right? So it's much more likely that they'll pause for 5-6 months, and then they'll cut. Then they're going to hike again. So I think that's where we're at here. This market is confusing for sure. And it's very tricky. I mean, just look at what happened. Well, first of all, obviously, last Friday, so the last time that we did a video, we were over here. We were talking about last Friday, so 2 Fridays ago, session where 43.50 held, market bounced a bit, and I basically said, we're set up for a bounce next week. Well, we got that bounce for sure. But then look at what happened Wednesday and Thursday. So this is the Wednesday candlestick. This is Thursday, the big red one. So the market is tricky because Nvidia earnings came out right here. So this was the market close Wednesday afternoon, 44.48. This is Nvidia earnings getting announced 5 p.m. on Wednesday afternoon, driving the futures up almost 30 points on the S&P futures, right? And actually, let's just pull up the Nvidia chart. I had it up before, but okay, here we go. So this was gapping higher Thursday morning above $500 a share. And actually, in the after hours on Wednesday, Nvidia traded up to 518. So 518, we're talking about trading up 10% for a $1.2 trillion market cap company. So there's no doubt that the Nvidia earnings beat estimates across the board. There was blowout numbers. But at some point, you just have to ask yourself, okay, is that really worth another $100 billion on the market cap? $100 billion. The numbers are massive. When we talk about Apple and Nvidia and Microsoft and Tesla, I mean, the numbers are jaw-droppingly large. And I just think that last week gave a wonderful lesson in expectations, market expectations. So the amateur market participant, market observer will turn on CNBC, watch them just gushing on the Nvidia earnings report. Oh, blowout across the board. This is incredible. They are just all over it. They're, salivating over these earnings. And they're going to say, well, Nvidia's going to go up. I got to buy it. I buy it in the after hours, over 500. Doesn't matter. Look at CNBC. They're in love with it, right? The professional says, we knew Nvidia was going to beat. We had the forecast that they were going to be. That's why we bought the stock over here or over here. Now this is an opportunity to liquidate into the orgasm, the CNBC market orgasm. So retail investors are the ones buying in the after hours above 500, and professional traders are the ones selling it down. And they sold it the whole day on Thursday. So this big black candlestick opens above 500, closes down into the 470s, and then proceeds to sell off even more on Friday, getting all the way back down to 450. So, Nvidia gave a wonderful little round trip last week where it opened up on Monday morning, gap open from the 440s, traded up above 500 after earnings, and ended the week back at 460. Now, that's tactical short-term trading, and I don't think we should make too much about that drop in the after hours from 500. I don't think that this is bearish for Nvidia, really. I think it was just high expectations. The earnings beat was priced in, as crazy as that is to say, because it was such a big beat. But really, how much can a $1.2 trillion market cap go up? And I'm sure that if this does pull back into the 440s, 450 area, it will find support. Okay. If it doesn't, if Nvidia keeps dropping, then that's obviously going to be a big negative for the overall market, because this is a market leader, just like Tesla was a market leader in 2020 and 2021. Tesla caught a bounce too. I played that bounce from 215 up to 240. That was a nice trade, but it could be very much of the dead cat, nature, really. This is a pretty big drop that it had, and this is a very shallow bounce so far. So if Tesla cannot keep going up above 240 next week, that's a feather in the bears camp. That's something to keep an eye on. I will say that you have the potential for something that sort of looks like a head and shoulders top in the S&P chart. Shoulder, head, shoulder. It's definitely not perfect. It's not textbook by any means, but you know the idea and the nature of the head and shoulders top pattern is present here. And if this really does fail, the back test of the 50-day moving average last Thursday, if that fails, then the essence of this pattern is definitely present, and support around, let's call it 430, definitely has to hold. If this breaks under 430 on a weekly closing basis, then I think we could say that's a completed head and shoulders top. Right now, it's way too early. The pattern isn't even formed, but it's there. It's something to keep an eye on in the future. But mostly, the market bounced last week, and the bounce ran into resistance at the 50-day moving average. So the back test of the 50-day was where it sort of failed. And relative strength is under the median line. We're under the 50-day, which is now flattening out. It's no longer clearly rising, right? So there's some things here to cause some concern from a bullish perspective. Okay, it's not such a clear market. It's not such a clean uptrend like it was in May and June. It's much messier now. I do want to talk about some clear trends, some uptrends in the market. So this chart of the uranium sector, the URA, is one that I've been looking at for the last couple of years. In fact, I started drawing this triangle in early 2022, right? This downtrend line here off of this peak. So here we are, and this triangle pattern is beginning to resolve to the upside. So things that I look for in a bullish chart are price above key moving averages, check. Relative strength above the median line pointing higher, check. A consolidation of a major bullish trend, a big move higher, 2020 to 2021, check. This consolidation is the consolidation of these massive gains that the URA had between 2020 and the end of 2021. And the consolidation has been mostly on declining volume, but recently some bullish, signs of accumulation has shown up here on the weekly chart of URA. And just frankly, this now looks like it's breaking out from this triangle. Now, I wouldn't say this is a confirmed breakout by any means, but right now it is clearly starting to move above the top rail of this 2-year consolidation. So uranium, URA, is definitely a bullish sector, and the most bullish, most important stock in the uranium sector is Cameco, CCJ. Incredible uptrend. I was pounding the table on Cameco at the end of 2022, early part of 2023, and it has been one of the strongest performers out of any stock, especially large cap, up more than 60% year to date, and just a beautiful uptrend. It hasn't even come back to the 50-day since May. And this kind of strength, this is a secular trend. This is the kind of chart that you just ride it. You don't try to time it. You just ride it. The uranium sector is clearly one of the bullish secular long-term trends that is available out there to investors. NXE, which is next gen. Notice the volume last week. This is absolutely massive volume, over 20 million shares for the week in next gen traded on the NYSE. And next gen has been consolidating for more than 2 years, basically between $3.50 a share and $6 a share, just ping ponging back and forth. It's above the key moving averages. Again, it's got all the things that I look for in a bullish chart is present here on the next gen chart. Let's pull it a little closer, and I just want to show you last week's candlestick. So this is a chart that's been grinding up ever slightly higher every week for many weeks in a row. And then last week, it jumps almost 7% on the highest volume in almost 2 years. Okay. So this is definitely a chart to keep on your radar. But Cameco and URA are obviously the simplest, safest ways to play the sector. You can get down into the juniors, Sky Harbor. This is obviously consolidating for the last couple of years as well. It had an up week along with the sector last week as well. But something that stands out about all of these charts is just how they've consolidated. Wrong one. How they've consolidated so well for such an extended period of time, and now they're just starting to move into clear uptrends and breaking out above key technical levels. Next gen is basically at 52-week highs here. It's consolidating right near 52-week highs above $5 a share on the NYSE. American airline. Okay, so uranium is a bullish secular theme, uptrends intact across that sector. That's probably one of the highest conviction plays I see out there across the broader market. Last week, I mentioned some individual charts, AAL, American Airlines, how this was coming down to test major support around $14.50 to $15 a share. This is now deeply, deeply oversold and hanging on to that support near 14.50. This is one that needs to bounce this week. It's oversold enough that it can absolutely bounce 5 to 7% pretty easily. If it doesn't, that's a really bad sign. And you also have to ask yourself, if airlines, it's not just American, Delta as well, okay? If airlines are doing so poorly, if their shares are getting sold off aggressively the last couple of months, what does that say about the strength of the overall economy? Definitely is not a compelling sign of strength of the consumer if airline stocks are getting um, sold off, like this. Now, obviously, something happened right over here where airlines were a leadership sector in June. Okay, they performed fantastic in June. Something happened over in this time frame, uh, and throughout August, clearly somebody, some airline focused hedge funds or something, they're getting some data that all is not well in airline land. So AAL is a chart definitely to watch this week. This one should bounce. If it doesn't, I don't think that's a good sign for the economy, the overall market. Lululemon. So this one, retailer focused on yoga apparel. They've branched out into men's apparel. You can get a lot of different stuff from Lululemon. It's all extremely high quality. This is a consolidation that has been taking place for months now in Lululemon, and they will report earnings this week. I believe it's on Wednesday. I think this is one to watch as well. Um, I may take a trade on this week. Definitely a breakout above 390 would be something to play just from a chart perspective. But obviously, there is risk. You have this gap, this big gap in the chart that goes down to about 325. So that's your downside risk is that gap can get filled in. This is a very weird chart where you have a gap up, you have this big drop, you have another gap up. Definitely a weird trading stock, and you can see that it tends to gap and then sell off onto that strength, right? Like even after this gap, it caught some selling. This was pretty extreme downside here at the end of May. And then obviously you can see it gapped higher, but it's just been consolidating range bound. This is one of those charts that I would definitely be looking to play on a breakout above that 390 level. Yeah, I'm just taking a look at the weekly chart. So this is in a major uptrend. I mean, this stock was 125 bucks a share in 2019. This is in a major uptrend. This is a company that has continued to grow earnings, grow revenues, and find new ways to grow its business and give consumers what they desire, right? So I wouldn't bet against Lululemon at all. In fact, I might bet on them. So moving along, away from just individual stocks, it's sort of bigger picture stuff. The US dollar yen, it feels like the yen is taking on increasing importance in this market. And the fact that it's been so weak and continues to be so weak, it feels like we're coming up to, I don't know, a culmination, a key inflection point. It feels like it's getting there. I mean, just take a look at the US dollar index weekly. So we'll have this downtrending channel that I showed last week, and the US dollar had another up week. So we are talking about 6 green weeks in a row for the US dollar index. Some people ask me, is that a breakout from the channel? Is that an upside breakout? I don't think this is a confirmed breakout yet. In fact, I wouldn't be surprised if it just rolled right back over now. Okay. Yes, there is a line there. Price is above the line, but it's not that simple. Okay. I really think that we need to give this some time, and I wouldn't be surprised at all if we see the USD JPY begin to roll over. Maybe it's going to need another week to really get to an extreme point where there will be central banks intervening, and I did say banks. It won't just be the Bank of Japan. It could be the Fed as well. And remember the Fed has swap lines with the BOJ. So if they want to affect the exchange rate, the dollar yen exchange rate, they can do it very easily. It's just that they don't want to do it unless it's getting to a critical level. And I feel like the USD JPY is getting to a critical level. If we look back to last year, this is where the intervention started to take place, and you can see what the dollar yen did following that intervention. So things have been relatively quiet recently, but the yen has continued to weaken. It feels to me like with what's going on in China's doing all these stimulus, measures. They're trying to encourage people to buy stocks. They're easing mortgage lending. They're pulling out all the stops to try and stimulate their economy, right? So there are some things going on here in the global macro scene that is worth paying some attention to. It's tough to figure out exactly how things are going to play out, but it does feel like a lot of charts are coming up to a key turning point. Somebody asked me about precious metals and interest rates. Well, so when we talk about precious metals, we're talking gold. Um, all the other ones are just much less important than gold is, right? The problem with gold and interest rates is that the history is not that long. Remember that gold was fixed at $20 an ounce for a long period of time, and then it was fixed at $35 an ounce, right? So the gold only became somewhat freely trading in the 70s, in the early 70s. So the history that we really have in the modern era, I'm not going to go back to the 1600s. In the modern era is 50 years. We have 50 years of history of gold and interest rates. Um, so in the 70s, obviously, treasury yields were very high. For most of the decade, they were in double digits. During that decade, gold rose tremendously from $35 an ounce to almost $1,000 an ounce by 1980. That is not really an analog that we can use, though. That was a very special decade. It was the decade that gold was able to trade freely. People could buy gold. Gold became a freely traded, asset, a futures market. You could buy a gold bar on the COMEX, right? It became gold after being, held down to some extent by the government for 100 years. Gold was now free trading, and gold was able to rise to a level that people felt was appropriate, given inflation rates, given government debt, given uncertainty in the world, right? And yeah, so you could say, well, gold rose during the 70s as treasury yields rose, as the Fed raised interest rates. gold rose. Yes, that was a very special period of time with, to some extent in the late 70s, it was runaway inflation. Um, there was a lot of geopolitical turmoil. It's funny how we forget, like, we think that this last few years have been difficult and very unpredictable in terms of macro events. We had COVID, we had the Russian invasion of Ukraine, we had January 6th, 2021, right? All these different events seem so extreme and unpredictable, but in the late 70s and early 80s, we had the Iran hostage crisis, right? 1975, we had the end of the Vietnam War. 1979, 1980, we had the Soviet invasion of Afghanistan. Um, there were other events that occurred throughout the late 70s and 80s I'm not even thinking of, right? There was a lot of unpredictable stuff. Plus, we had the Cold War. Um, so I don't really think we can use analogs. I think, just simply put, if I look at a 20-year chart of 30-year, treasury yield, gold at the top, correlation at the bottom, generally speaking, gold has a negative correlation to long end yield. So the 10-year, the 30-year treasury yield generally has a negative correlation to the gold price in US dollar terms. Not always, though. Not always. Um, there are times when obviously there could be um, rising yields and rising gold price. We saw that for some period of time in 2009, where yields were coming off a very low level and gold was, becoming a favored asset class as the Fed embarked upon quantitative easing and trying to repair the economy from the financial crisis, right? So, in extreme circumstances of turmoil like 2008, 2009, yields on treasuries and gold can move up together or move down together. Like in 2008, everybody ran into treasuries, drove the yields down, but also they sold off gold to meet margin calls. The gold price fell too, right? So the correlations can change, but at this point in time, in this situation here, it's much more likely that rising yields will be gold negative. Falling yields will be gold positive. Okay. And I really feel like looking at this 30-year treasury yield chart, this like 4.3, 4.4%, yield level is obviously a key level, because if we break out to new multi-year highs in yields, most likely that's going to weigh on the gold price. Most likely. And are we going to then, the question then becomes, are we going to be in a new paradigm of treasury yields above 5%, going back to the early 2000s? Like over here, look to the left in the chart, the 30-year treasury, was above 5%. Is this going to be a completely new environment than what we become, accustomed to the last decade? There's a lot of complicated questions here, not easy to analyze. But look down here at the correlation right now: 0 gold to 30-year treasury yield, monthly time frame. The correlation between the two is 0. So not even really a question worth pondering too much. But if I gunned in my head, lower yields, more bullish for gold. higher yields, more bearish for gold. Yeah, and this is a really big point, a moment in time here. It could be the next month, it could be the next 2 weeks, but right now, what are Treasury yields going to do? Are we going to see the whole yield curve shift up towards the Fed funds rate? Remember, Fed funds is 5.5%. 10-year yields at 4.24% now. So are we talking higher for longer, as in like 6 months longer or 6 years longer, right? And the bond market, the US Treasury market has to tell us, they have to give the signal, what are you thinking here, right? And they're still thinking that the Fed cannot hold rates at this level for very long, and we'll probably be back at 4% on the Fed funds by the end of 2024 or early 2025. Gold has been messy. We're currently trading 1943.60 in the December futures. But, big picture, it's been just a choppy, range-bound trade here for months. The one thing that I would really make note of, keep it simple in terms of the analysis here, is that price is still above a rising 200-day moving average. Okay, so just simply put, we're still in an uptrend. As messy as it's been and as ugly as the month of August has been for gold, we're still above a rising 200-day moving average, and this still is an uptrend. So for me to change my tune, I got to see 1900 go. Okay, I got to see a breakdown under 1900. That would obviously be the new information. We are in a down leg here, and we probably need to test lower, maybe down to the low 1800s. But as of now, price is holding above 1900, and certainly if we see a move back above, let's say 1970, 1975 in the next few weeks, that would be incredibly encouraging. I don't have a prediction, but I know that these currency charts and the treasury yield charts are going to have a lot to do with what gold does, right? So if the US dollar does decide to roll over here, and this is a failed breakout, this little blip above this trend line, then that's going to be probably pretty good for gold. If this is a US dollar upside breakout, and we're going to see the dollar index up 105 or 106 in the next couple of weeks, then that 1900 level could absolutely be at risk. Non-farm payrolls report this Friday. It's obviously going to be critical for gold. Silver, we're above 50, 200-day moving averages. This is not a bearish chart. Okay, so I'm not going to make this too complicated. This is not a bearish chart. Okay, it's an uptrend. Lower left to upper right. This is an uptrend. I don't think you need to make it more complicated than that. Yeah, we could draw some trend lines off the top here and make it look all pretty and like we know something, but simply put, this is an uptrend, and I don't think you need to overthink it. Silver held support where it had to, 2250. 2250 held. Okay, bulls are still in control. They still got the ball in the silver chart. Platinum, this is interesting because platinum kind of looks like it had a failed breakdown here in August. Okay, this 900 level in platinum has been massive support for a long period of time. We broke under 900 for a few days here this month and zoomed right back above, trading about 950 now. Platinum looks pretty good. I mean, in platinum terms, like good for a move up another $50 to 1,000. I wouldn't get carried away because it's platinum and it just doesn't seem to trend for very long. But this does look like a failed breakdown. I like the platinum chart. Palladium, this is yucky. The fact that it's hugging the lows, even when gold and silver bounced last week, not a great look here in palladium. But it's that support. Just like 900 is big support in platinum, 1200 is big support in palladium. Getting to some gold miner charts. So now for the bad news, right? So like I kind of said, gold, got to give it the benefit of the doubt. It's still in an uptrend, although I can't guess the next 30 or 40 bucks in price. It could go either way. Silver, it's not a bearish chart. Still, a strong uptrend, and it found support where it had to at 2250. Now getting into the gold miners. IAG, IM Gold, got extremely oversold, played that bounce last week, but got out. Really not a very impressive bounce at all. And it's, even by Friday, it was giving it back. We got the death cross coming. This looks like a dead catter. Okay, so this is just ugly here in IAG. This looks like a dead cat bounce. This does look like a big topping pattern has formed in this chart in 2023. If support at, I don't know, what is it, 210 breaks? I don't know. It doesn't look good. Okay, this is an ugly chart. Bears have the upper hand in IAG. GDX. This looks like a dead cat bounce. So we played the bounce from 2740 up to 2830, 2840, got all the way to 29, but former support became resistance. And this doesn't look great. I mean, when you have a sell-off, 20% sell-off, and then you get like a 6% bounce, that's the definition of a dead cat bounce, right? So gold miners, guilty until proven innocent. This needs to get back above 30 bucks to prove itself. Okay. This just doesn't look good. So if the gold miner charts are looking bearish, GDXJ, same thing. It's a dead catter in a clear downtrend since April. And notice how the GDXJ topped in April, gold peaked in May. Right, so the GDXJ was making a lower high in May when gold peaked. So the gold miners are not necessarily a leading indicator of gold, but they have a tendency to lead it. Okay, it's not 100% by any means, but the gold miners are, you definitely don't want to see gold miner charts like we have right now and taking a bullish view on gold. Okay, it's just that this doesn't add up to have the gold miner charts look this ugly. This is not bullish for gold. Okay, this is not, the people that are trading the stocks are not expressing a bullish view of gold here in the near term, right? So what did I say there? I said the metal charts like platinum, like silver, like gold look pretty decent. They're not bearish, but the miners, generally speaking, not all of them. I could pull up some miner charts that aren't terrible, but there's a lot that are terrible. Newmont, the biggest gold producer, is the definition of a terrible chart. This is as ugly as it gets, folks. So, yeah, it's hard to be really bulled up on gold when the big gold stocks are this ugly looking. So share structure, junior mining, and position sizing. So now we're going to drill down into some junior charts. So Founders Metals, which I have no position in, had a big move up last week on drill results from Suriname. So I'm not going to go into the details of the project or the drill results, but they were very good. Really impressive high grade gold intercepts from Founders Metals. Now, notice how it surged on Thursday and Friday last week. So from 40 cents to 75 cents, almost 100% move there in 2 or 3 trading sessions for Founders Metals. And the volume, it's about 1 million shares a day on Friday. And you can see, got super overbought, but that's what happens in these little juniors when they have, new discovery, some big news. They're going to get vertical. It's going to be like a rocket taking off into space. And this one moved really nicely. And you can see that most of the move happened during the trading session. So actually, the news came out Thursday morning. The gap higher wasn't even that big. Okay. It's like it gapped up like 5 cents. Yeah. In fact, let's pull up the news. Founders. Okay. So this was Thursday morning. 15.5 meters of 30.72 grams per ton gold. That's one hole. Another hole at 7 meters of 8.74 grams. Another hole had 8.5 meters of 6 grams. Another, yeah. So just, these are pretty good results. And this is not just in one hole, this is multiple holes. Continuity to depth at a long strike. And there's a few lessons, there's a few observations to make here from Founders Metals. The first one is this junior gold sector environment is so bad that a company can drill a hole like this and their stock only gaps up 5 cents on the open. So you could have bought it Thursday morning at 45 cents and it went up to 75 cents by Friday's close. Friday, it didn't even gap up, it opened flat, right? So people just aren't paying attention. People have given up on the junior mining sector. It's that bad, okay? All the contrarian stuff that I look for, that I've seen in past cycles, it's all showing up here. People are getting really nasty. People are saying horrible things about, other people in the sector. Investors are not interested, period. They're just not interested because the performance has been so bad and people have lost so much money, right? And a company like Founders can put out incredible news and only a handful of people are paying attention on Thursday morning. Now there's a lot more people paying attention to this one because of the price action. So the price action is what gets people interested. People don't want to buy it when it's only up 10%. They want to buy it when it's up 100%. When the chart is breaking out, that's when people get interested, right? So Founders now has some people's attention. They didn't have it last Wednesday or last Thursday before the market opened. It took a few days of this news getting around to get people interested. Aston Bay. Oh, let me say one more thing about Founders. So this is important because the share structure of this company is pretty tight. Only 43 million shares out. A lot of them are held by the management team, the corporate insiders, and pretty tightly held stock overall. Some shares came free trading in the middle of last month. You see this little blip down in the chart, but the market handled it pretty well. And obviously, as you can see, this is at new all-time high. So Founders has a tight share structure, the kind of share structure that you actually really want to see on a company that's putting out good results like they did last week. So Founders is one to keep an eye on. Again, I have no position. Aston Bay is one I discussed in last week's video. So this one continues to consolidate. The market is waiting for the next news release from American West, from Storm. It's consolidating nicely above 20 cents. Volume is trickling lower. It's coming to like a culmination here in Aston Bay, where probably in the next 2 to 3 weeks, we're probably going to get at least 2 pieces of news from Storm. And that's going to kind of make or break this, I think. Worst case, the assays from holes 2 and 3 are not fantastic, and they don't hit sediment hosted copper at depth in hole 5 or subsequent holes. What could happen? It could drop 50%. It could come back down to 10 cents maybe. Best case? Well, obviously the best case could be new highs and, quite a bit above the 34 cent level. But it's going to hinge on the news from Storm. I mean, certainly the assays matter a lot from the first 4 holes, and hole 5 matters a lot. Every hole matters here, okay? Because there's only so many holes, and the season to drill up there in the Arctic is only so long, right? We're coming to the end of the window. There's definitely a risk for sort of selling on the news coming up here, just because then you're going to have an 8-month wait for the next phase of drilling, right? But just from a chart perspective, a technical standpoint, this is a healthy consolidation here. It's worked off the overbought in the last couple of weeks, and it's consolidating above what I would consider to be the critical support level of the bullish pattern at 20 cents, right? If it breaks under 20 cents, then that changes a lot of things from how this looks from a technical perspective. Position sizing and risk management. So I'm just going to touch on that briefly. My rule is one stock cannot take up more than 10% of my, account, my risk capital. Okay. It cannot take up more than 10% of my account. And why is that? Especially in junior mining? Because just think, imagine if you had 25% of your account in Aston Bay, and they come out with news, from their partner in Australia, and hole 5 doesn't hit. The stock drops 50%. Well, then you've lost 12.5% of your account equity, right? You had 25% in it, and it dropped 50%. You lost 12.5%. That's a pretty heavy blow to take. That's a big chunk of your account, just got taken out. That's a lot of risk to take. Whereas, if you only have 10%, well, if that 50% drop happens, it's 5% of your account. Not fun, but not fatal. And remember that this is kind of a go big or go home kind of a play, right? So if you have 10% and Aston Bay jumps another 100%, well, you've just added another 10% to your account equity. That is meaningful. That is meaningful. And, who knows what could happen, with these two stocks. But just, hypothetically, in junior mining, we are really going for the 10 bagger. And a 10 bagger on a stock that accounts for 10% of your account equity is equivalent to a nearly 100% jump in your account. Now, 10 bagger is a 10x, and a 10x is a 900% gain, right? It's not 1,000% gain. But it's meaningful. Your account basically doubles, okay? Like, I'm not going to split hairs here on the math, Your account goes up 90%, your account goes up 100%. It's very meaningful. It's a big jump in your bankroll. And that's what we're doing. We're trying to maximize the potential to have a return that is a game changer, while also trying to minimize the risk, trying to manage the downside as best as we possibly can. Now, I think that, like somebody asked me, well, if you had Aston Bay at 10 cents, would you sell some at 30? I mean, I think that's completely reasonable, unless you had so little of it that you didn't want to take any off the table. Like if you only had 1% of your account in Aston Bay at 10 cents and it went to 30 cents, well, now you're up to 3% of your account. But still, it's not too much. And you want to maximize your potential to hit a big win if this does go up a lot more, right? But generally speaking, I mean, if you have a 3x on a junior miner, taking some off the table is the prudent move. Simply put, people who say, I never sold any, and they're talking about that one stock that went from 10 cents to $5, and they say, yeah, I never sold any. I wrote it all the way. Okay, well, that's great that you have a 50x. That's fantastic. But if that's your approach, then how many juniors did you ride from 10 cents to 30 cents and then back down to 2 cents? Because that is the norm in this sector. It's the norm to have the stock round trip on you, and not just round trip, actually go through your entry, right? It would not be unusual. Again, I'm just speaking in general. I'm not making a prediction here. It would not be unusual for a junior mining stock to go from 4 cents to 34 cents and eventually come back to 4 cents or 3 cents or 2 cents. It would not be unusual. In fact, it's almost to be expected, quite frankly. Okay. So taking profits on big moves is not a bad decision. But at the same time, I say that I also don't want to put myself in a position where I'm always selling on a double or always selling on a triple and never giving myself a real chance at a 10x or a 20x or a 30x, right? And quite frankly, that's where the fundamentals come into play. And so based upon what I've seen from Storm and Aston Bay so far this year, it has not given me a reason to sell the shares I bought at 8 cents, right? It has not given me a reason. There's not been a red flag or a sign that something's wrong yet. Now, from a risk management, bankroll management standpoint, if you bought at 8 cents and it went to 32 cents and you've got a 4x and you just prudent profit taking, sure, that's fine. That's absolutely fine. But if you want to hang on to some for the chance at that 10x, then you've got to be able to withstand a little volatility, a little bit of weight, a little bit of, ooh, I'm not sure what hole 5 is going to bring. What if the assays aren't good? All those doubts that start to creep in, right? And quite frankly, I'm just going to be honest here. If we don't get news from, American West this week, there's going to be a lot of doubts creeping in. And you're going to see people say, oh, it must be bad news. It must be bad news. And we see this happen many times in junior miners. The longer the wait, the longer the market waits for a news update, the shakier it gets. And usually at some point a sell-off happens. Even, just waiting for the news because the wait is too long, right? At this point, I don't think the wait is too long because we just got news like, I don't know, what was it, like 8 days ago? But let another week tick by, especially when the company gave guidance that assays would probably be out this week here, the end of August, and that's a whole nother story, right? So that's it for this video. I think it's been long enough. The S&P chopping sideways. I think that if there's a parting thought here, it's that expect the market to sort of tread water early in the week because it's the end of August. And then Friday with the non-farm payrolls might generate a big move. And then obviously after Labor Day, it's game on, right? It's absolutely game on. And we should get a lot of volatility, a lot of trading opportunities, and a lot of direction in some of these charts that I pointed out are at potential key inflection points. So thanks a lot for watching. Wish you the best. Stay well. And again, if you found value in this video, please hit the like button and subscribe.